Most traders think they must be right to make money in the markets. But is that really true? In this video, we'll show you how you can be completely wrong and still make money due to the power and flexibility options trading can offer. I'm Mike Bellafiore, and we're a long-standing proprietary trading firm in New York City with numerous highly successful traders, almost all of whom started their trading careers with S&B. We hope you agree you found the right place to potentially grow your trading account.
Hi, I'm Seth Freudberg, and I'm the head trader of S&B Capital's options trading desk here in Manhattan. And as you probably know, most day and swing traders actively trade Tesla stock. And you're also probably aware that Elon Musk, his little side trip into social media through his acquisition of Twitter, didn't exactly work out that well for Tesla stock, with, among other things, investors concerned that he was spending so much time on his Twitter acquisition that he had lost focus on Tesla, which was experiencing some challenges of its own. And so trading at 402 at the beginning of the year, Tesla began to sell off way down to 122 on the last trading day of the year, an incredible 70% drop during the year. However, right after New Year's, Tesla began to bounce, and by February 7th had made it all the way back up to 196. And so one of the traders on our desk reached out to me and asked me to design a trade whose premise was that Tesla has, almost doubled since the end of the year. And so it's likely at this point to pause and probably pull back for a couple of weeks to digest a little bit of the significant rally that started at the beginning of 2023. Now, what we came up with requires a little bit of knowledge of how options work. And I realize that most of you know something about how options work, but just for a quick review, and this will be fast. What's known as a call option on a stock entitles the buyer of that option to purchase 100 shares of that stock at a certain price called the strike price of that option, regardless of what price the stock is actually trading at any time before that option expires. What's called a put option, on the other hand, entitles the buyer of that put to sell 100 shares of the stock he owns at the strike price of that put, again, regardless of what price the stock is trading at any time before that option expires. The buyer of the option pays what's called a premium to the seller of the option because the seller of the option is taking the risk that the stock will go past the strike price of the option, in which case the buyer can exercise his option. So in the case of a call, even if the stock's gone way above the strike price of the call buyer can exercise his right to buy 100 shares at the strike price, paying way below market. Or conversely, on the put option, even if the market goes way below the strike price of the put option, the buyer of that put option has the right to sell his shares of that stock at the strike price of the put that he's bought, even if the stock price has gone way below the strike price of that put option. Now, on the other hand, at expiration, if you sold a call and the market closes below the strike price of the call, then unless the call was previously exercised, that call expires worthless and the call seller wins. He just pockets the premium. Similarly, if you've sold a put and the market closes above the strike price of that put, then unless the put was previously exercised, it expires worthless and the call seller, again, pockets the premium and wins the trade. Okay, so with that said, let's head back to February 7th when Tesla was trading above 190. And so let's say that on that day, mid-morning, we pulled up an options chain, which expired a few weeks later on February 17th, and we sold 30 of the 205 calls and 30 of the 170 puts, while simultaneously buying 30 of the 215 calls and 30 of the 160 puts. And when a trader does this, selling calls at a higher strike price than the puts he's selling, and surrounding both the short calls and the short puts with long calls and long puts further from the market, then he is employing an option strategy known as the iron condor, which professional traders use all the time when they're expecting a pause in the midst of a large price move, such as the early 2023 Tesla rally. Now, let's first examine the cash flow of the trade so we can begin to understand how it works. And so first off, we sold those 205 calls for $5.60. And since each call represents 100 shares of stock, you multiply that price by 100 and you sold 30 of them. And so you multiply that further to come up with total cash flow coming from those calls into your account in the amount of $16,800. And with the same calculation, you see that we collected $59.70 for selling the 170 puts. And then we turned around and spend $9,900 on the 215 calls. And we also pay $26.10 for the 160 puts, resulting in a total net positive cash flow of $10,260. And that flows right into your account at the beginning of the trade. And your broker, by the way, will require $19,740 in capital in your account to execute this trade, which is also the worst case scenario on the trade. And so that's how the trade starts. Now let's move to a few days later. And as it turns out, the trader was a little premature in his bearish call on Tesla. And in fact, the stock rallied further up over 200. And so at that point, for reasons you'll understand in a little bit, so hang in there, the trader adjusts the position of the trade by employing what options traders refer to as a call Condor roll, where he buys back the short calls at 205, sells off the long calls at 215, and then rolls them up so that the short calls are now located at 220 and the long calls are located at 230, in both cases well above the market. So after the roll is completed, the position looks like this. It's important to take a look at the cash flow situation once we've executed this Condor roll. So let's start with remembering that the original Iron Condor brought in $10,260. But then we had to buy back the 205 calls, and those had gone up a lot because of Tesla's continued rally. And so those cost $10.15, which when multiplied out, as we did before, results in a payment of $30,450, as you can see from the calculation. Of course, we sold off the calls we originally bought also, which had gone up quite a bit, and so we were able to get back $18,150 in cash flow from that sale. And remember, we relocated the short calls to 220, so we received some more cash for selling those, just over $14,000 in fact. And finally, we also reestablished the protective calls at 230, so those cost us money. Those were $81.90. And so if you net it all down, our positive cash flow as a result of the roll is now down quite a bit to $37.80, but that's still a healthy potential profit on the trade. Okay, so now let's move forward to expiration day. And as you can see, that anticipated sell-off of Tesla, it actually never really happened, as the stock closed at 208.31 that day. So when options expire, we can finally give them a final value. And let's take a look at how these options were finally valued on that day. And as you can see, it's pretty simple because they all expired worthless, right? Because the calls are located at 220 and 230, and both prices are well above its closing price on expiration day. So the right to buy Tesla at 220 or 230 when the stock's trading at 208.31 is obviously nothing, because no one's going to pay more for the stock than the price they would pay if they just went into the open market to buy the shares. And so obviously those are worthless. And the same goes for the puts, because they were at strike prices well below where the stock closed, meaning that they've got no value because they only have a value if someone who owns Tesla stock wants to sell them, and they certainly aren't going to sell their shares at 170 or 160 if the stock is trading over 200. And so those go out worthless also, meaning that the trade simply expires. The options have no value, but the trader, he still has that $3,780 that he kept after he made the Condor roll. And so that cash just turns into pure profit and remains in his account as profit. And so what I'd like you to take away from today's video is that option strategies have a very unique trait that no other trading instrument has, and that is that options trades can be modified in the midst of a trade, which is what we did when we executed that Condor roll, when our initial thesis proved to be wrong, as it was in this case, when the trader expected Tesla to sell off. And once we make those adjustments, in many, many cases, we can win on a trade that was otherwise headed for a loss if we didn't make that modification. That's why people love options trading once they get the hang of it. In what other kind of trading can you be flat out wrong on your thesis and still make money? That's the beauty of options trading and the reason why so many professional traders use options as a key element of their trading practice.
It's one thing to be wrong and still make money. But what about when you're right, get stopped out for a loss, and then the market goes your way? Check out this video appearing on your screen right now to learn how options trading can help you avoid this frustrating issue as a trader.